Colorado Springs is just really well-rounded, in my opinion. There's a lot of military bases, which has historically been very stable when it comes to the economic impact of that. But then we also have a lot of tourism features as well. Pikes Peak, Garden of the Gods. People come from all over to visit those things. And as far as I know, they're not going anywhere. And then recently, there's been a lot of tech coming to the city. So that's kind of been exciting. And that, obviously kind of bumps up median income and all the things that come from that.
Hey everyone, Chris Lopez here. And in today's podcast, we are going to do the spring 2024 real estate investing guide for Southern Colorado. So I have Jenny Bayless on the show with me to come talk about what's happening in Colorado Springs and what is happening in Pueblo. How are you, Jenny?
I'm doing great. How about yourself, Chris?
Doing good. We were going to record this in person, and then the hazmat spill closed down 25 in Castle Rock. So now we were doing virtual.
Yep. I didn't want to risk it, and then I found out that the highway was actually closed. So I think it was a good decision.
Yes. So everyone, we'll get you all the information here. And we have combined this Colorado Springs podcast here with the main channel podcast on Denver. We'll be doing regular updates on Colorado Springs and Pueblo on the main channel here in Denver now. But Jenny, I'm excited to go through the stats with you. You've got some really interesting deals and a theme of Fourplex going on here.
Yeah, I'm excited to talk about it too. So we'll just jump right in. So this is kind of similar to what we've chatted before in terms of learning the lingo. So we'll just leave this here for anyone who wants to use it as sort of like a glossary. If we use a term that maybe you're not as familiar with, you can refer back to this on our linked PowerPoint on the website. So just leaving that there. So we don't, go into details that people already know, perhaps. And then the 4 returns of real estate. Chris, I think you've been, focused on educating people on 4 returns of real estate as long as I've known you, probably. So, it's just cash flows and everything. And I think that, you and I love to talk about it, but we'll just kind of, briefly talk about appreciation, cash flow, debt pay down, and then there's tax benefits, which I think we've focused a lot on recently, educating people on what potential tax benefits there are to real estate. So that's kind of been fun.
Yeah. And actually, one of the deals you're going to go through, Jenny, you're going to talk about how using depreciation to help, minimize the tax bill. But since cash flow is a lot harder in every market now, I think it's really important to get focused on the other 3 areas. And I know, Jenny, you and I have both been using depreciation a lot more last couple of years to help kind of create a different type of cash flow by bringing some of the tax benefits forward. So it's actually a way you can either really limit your taxes or actually kind of bring cash flow forward in a different way. So really learn this, everyone. It's really good stuff.
So again, we have a little bit of a glossary on it, but we'll go into it with the real world examples as well on these 4 returns. So assumptions used in Southern Colorado property analysis. We're kind of joking before we started that, I had to increase, unfortunately, some of these costs, especially in the insurance piece of it. I mean, I don't know about you guys, but I have just been seeing huge insurance costs, sticker shocks across every single property in my portfolio, my primary home, like everything. It's been really dramatic. And I think that a lot of people are actually seeing this if they have HOAs. They've either already seen it in the form of, either a special assessment or increased monthly HOA dues. It has been really pervasive and it's really impactful to investors' bottom lines, I think. So just something to highlight. And then taxes as well. Taxes went up across my portfolio, as did probably everyone in Colorado, I imagine. So, it's just even more important that when you go to analyze a deal, you're looking at the current year's property taxes and not the previous assessed value, which is probably quite low compared to what it is now. So just, kind of like highlighting, take off your rose colored glasses on some of these costs.
Yeah. And just because you see a certain tax number in the MLS, as Jenny said, doesn't mean it's this year's taxes. So, double check the taxes for sure.
Mm-hmm. Financing methods. So, we're not going to go in detail as to each financing method on this, but I think that where rates are today, it's very important to shop around because a few years ago, 30-year fixed in the 3-4%, that was a no-brainer, I feel like. Whereas now financing is a lot more expensive. So it's definitely worth kind of evaluating your personal situation, your risk preference, the loans that are available to you, this property and that you're applying the loan to, and just kind of analyzing everything and seeing what might be the best product for you. So that could also make or break a deal nowadays, for sure. And then strategies. So, I think we have a lot of content that we could refer out, but just different types of strategies that we're seeing investors do. There's the regular traditional buy and hold, long-term rental, short-term rental, medium-term rental, room by room rental. And then of course, everyone's, probably the most popular that we interact with people on is house hacking. And I think that's still a very viable strategy down in Colorado Springs. So I think that this strategy in and of itself, it won't go out of style anytime soon from what I can tell. I don't know about you, Chris, but this seems to be kind of the tried and true strategy for a lot of investors that are looking to get into real estate.
Yeah. I mean, anytime you can buy an appreciating asset at 5% down, all the other details aside, you just kind of win on leverage. So yes, it's a great way, and the people can really get in there and create some, great like sweat equity type economics as well. But if you don't mind, go back to your previous slide, Jen. I'd love to kind of do a quick overview of kind of like how these strategies are, because long-term rentals are bread and butter. Short-term rentals used to be very popular in the springs until a couple of years ago now. So from a high level, like what's working and what's not working down there in Springs and Pueblo?
Yeah. So short-term rental, unless you're an owner occupant, I pretty much just recommend don't even bother because there are so many rules that, Colorado Springs municipality, I think it was like, I don't know, 3 or 4 years ago, came out with basically a rule that owner occupants, you may do short-term rental. That is fine. But non-owner occupants, you have to meet certain criteria to include a zoning restriction. So the property in itself has to be zoned appropriately. And then it also has to not be within a radius of 500 feet from a different STR licensed non-owner occupied property. So, or actually, no, I think it's any STR within 500 feet. So it's basically near impossible to find something that works. So, unless you find like a needle in a haystack, I don't recommend just having tunnel vision for that because of the restrictions that they have out there. So that's kind of my recommendation for a short-term rental. If you're doing an owner occupied short-term rental, I think if you want to turn it into an STR for while you're living in there for that quick cash infusion, like that's fine. But as soon as you move out, you're going to have to assume that you cannot use it as STR anymore. And you're going to have to come up with a different plan for that. And then medium-term rental, that was a strategy that we saw around COVID times, just because people were, nurses were coming in. A lot of people were traveling because they could work remotely. So they wanted to kind of check things out, stay in areas for a larger, period of time, but not totally move there. And it also kind of skirts around the STR restrictions in that it's legally a long-term rental if it's more than 30 days. So that was a pretty popular strategy. We are not really seeing that pencil out too much anymore just because vacancy has gone up quite a bit since, kind of the heyday of the MTR spree. And then room by room, I think that this is a fantastic strategy for people who are either house hacking or just, non-owner occupied investors, where they rent out just a room in a property and have a furnished common area. And that is tending to work really well in Colorado Springs. Like I said, just non-owner occupied or owner occupied is a very viable strategy. Each room is on its own lease, and typically on a per room basis, you're going to get higher cash flow. But with that, you're going to have higher management headaches. So just kind of keep that in mind.
And I want to highlight some stuff about the room by room, because I mean that is, I think, one of the best cash flowing strategies here in Denver and down south as well.
Mm-hmm.
But it takes more time, and it's just a more time intensive strategy. But it's actually just editing our 2024 real estate investing guide to Colorado with Red Miller's chapter in there.
Mm-hmm.
He's doing a lot of room by room, which I'm bringing up not so much to highlight the room by room opportunity, but more so to help help have investors realize other ways they can invest. He is a young guy in the early stage career, putting time and sweat equity into things. And he's actually partnered with a few people in later phases of their careers, in their 40s or whatever, with, more money and less time. And he has more time, less money for Miller's situation. And they've actually done quite a handful of deals that way.
Mm-hmm.
So good reminder in that, hey, a great way your cash flow is to be hands-on as an investor. But for some investors out there that don't want to do hands-on, I think there are some opportunities for some equity type partnerships. Hey, you bring the money, they bring the sweat equity.
Yep. Miller's kind of our poster child for both owner occupied and non-owner occupied room by room. So he's doing it all. I love it. So,
and as we're going through here,
yeah.
I know you're flipping through some slides, Jenny, but we are referencing the slides on here for those listening on the podcast. You can download the slides in the link as you especially get in the deal analyses, or if you can't find it, just email me or Jenny and we'll shoot it off to you.
Yeah. And just a plug, email info@envisionrea.com if you do want a copy of the Ultimate House Hacking Guide that Chris and Jeff and Joe Massey wrote a few years ago. I think that it's a really good opportunity to read about house hacking in Colorado.
So version 2.0 is in the works.
Oh, I didn't know that. Very cool.
Oh, well, we'll be reaching out to you soon for some updated Springs content. So you will know soon, Jenny. By the way,
right,
now you know.
I'll start working on it.
We officially kicked off last week.
Okay. Yeah. So, just kind of going into the Pueblo market overview, I will link to some of the past podcasts that we've done where we've really gone into, I would say, really extreme detail on some of these, sub pieces of the market, to include some of the economic development that's going on, as well as, really number and stat focused on the market itself. But kind of the key highlights that I like to share with people when they come to me and they say, I don't know anything about Pueblo, what can you tell me? Kind of the bullet point to that is I like to show this slide right here, and to describe it for people who are listening right now is I like to look for a couple of things when I'm evaluating a market. So the first thing is the population growing? So you can see that since 2000, the Pueblo population, although hasn't grown much and it hasn't been growing at the same rate that Colorado Springs has, it every single year it has grown. So in 2000, they have Colorado Springs at 540,000 population, Pueblo at 141,000 population. And then 21 years later, Colorado Springs is at 762 in population, and Pueblo is at 169 in population, 1,000 people. So I think that it's important to kind of see, the gradual incline of people moving to an area, meaning are people going to be there to rent your property? And then I also think that there's potentially a spillover effect from Colorado Springs into Pueblo, especially, those that might be working at Fort Carson on the southern part of Colorado Springs. Pueblo is more affordable, so you can get more house for your dollar. So I think that could also, play an impact, especially as affordability in Colorado Springs starts to get a little bit tighter. And then, which leads me to my next point, is how affordable are the rents in Pueblo? So rents have increased over the last several years in both Colorado Springs and Pueblo. But then I also like to take it a step further and see what is the actual affordability. So I like to compare the rental costs to whatever their monthly income is. And you can kind of see that Pueblo is hovering in that low 20%, whereas Colorado Springs is nearing 30% of people's monthly income. So I think that's kind of where that 30% mark is where it gets a little hairy. And I think it gets a little bit more difficult for people to afford housing once it crosses that threshold. So staying in the low 20s is a good sign, in my opinion. And hopefully it kind of stays to that affordability by hopefully monthly income, increases over the next couple of years. And then again, here's some links to what's going on in Pueblo. I think that these are all really interesting points, but we have really in-depth podcast episodes that you guys can look at, just including, what are some of the economic developments, what are public policies that are going on, what are some of the cool places to hang out even in Pueblo. I think it's really important to check that out. And then if you're interested and you are in Colorado, I always say take a day trip, go down and have lunch at the Riverwalk and just kind of get a feel for it. Going into the Colorado Springs market overview, again, we won't harp on this too much since I feel like we've done several pieces of content on this. But again, Colorado Springs is just really well-rounded, in my opinion. There's a lot of military bases, which has historically been very stable when it comes to the economic impact of that. But then we also have a lot of tourism features as well. So that's great. Pikes Peak, Garden of the Gods, people come from all over to visit those things. And, as far as I know, they're not going anywhere. And then recently there's been a lot of tech coming to the city. So that's kind of been exciting, I think. And that, obviously kind of bumps up median income and all the things that come from that. And then just showing some of the highlights that I have down here. There's an article, and I have that cited for anyone who'd like to read the full article. But one of the challenges that Colorado Springs has cited is that they have such low unemployment that they only have half a person for every one open job position, which that's crazy to me.
Wow.
Yeah. So very interesting stat, I thought. And then just kind of, this Colorado Springs market overview for average home price is pretty flat. Q4 of 2023 compared to Q4 of 2022, condos are at 0% price growth. Homes are up 4%, which, is pretty low compared to historical, about 5 to 6 per year, but not bad when everyone was kind of projecting that we were going to tank last year. So to kind of hold steady, I think that's really indicative of how strong of a demand that this market has. And then, inventory is just continuously not high enough. I think that's probably going to be like the biggest driver as to what's going to happen in the future is the inventory situation. And I think a lot of other cities can say the same.
Yeah, and I mean, there's a lot on this chart if you guys want to read through it all. But the story it tells is, the price growth has slowed, but nothing is really dropping or crashing. Mm-hmm. It'll be modest or probably below average appreciation for a bit.
Yeah, and I mean, I think we are all kind of projecting negative price growth, and for it to be, just slightly below average is very interesting to me. I wouldn't have anticipated that based on how quickly the interest rates grew. So I was pretty surprised to see how steady it held.
Gotta have inventory.
Yeah, yeah.
I think that's it.
So then just kind of going into the income properties, Your Castle posts a really cool chart on that where they actually find average price per unit. And so compared to Q3 2023 to Q3 2022, there was 0%, which it was double digits each quarter or each year prior to that, year over year. So I found that really interesting, which also kind of goes into what we're going to talk about with our specific deals. So no spoilers at this point on that. But I think that, income properties are really kind of seeing the brunt of that interest rate rocket upwards because, purchasing an income property is much more discretionary than your personal home, and that's kind of what I attribute it to. If an investor doesn't want to buy something, they're not going to. If you have to move to somewhere, you have to have somewhere to live. So I think that's kind of the difference between the two. I don't know. That's my assumption. What about you, Chris?
I never thought about it in that way of like the way you put it. The thing that I found really just odd timing on here. I was reading a phone transcript voicemail, and 10 minutes ago, while we were recording this, I got a phone call for an apartment building. Someone's trying to sell in Colorado Springs. I'll be forwarding that to you in a few minutes, Jenny.
Oh, nice. Yeah.
I just saw the message pop up on that. I haven't gotten to listen to it yet, but yeah. So, but this brings us to the point. Actually, we will see more about this in the deals. There are some opportunities out there now in the multifamily space, which are becoming more attractive than they were last year.
Yeah, and if I had to make a guess, please don't come at me if I'm wrong. I think this average price per unit, we will see a decrease year over year. At least as of right now, I think, because I don't know, I'm seeing some really good opportunities, so we'll see.
Yeah, because this data is from Q3 2022, mm-hmm. So basically, the end of last year, and we are at the end of Q1 now in 2024. So, there's a lag, and I would not be surprised, Jenny.
Yeah.
But we'll see. I don't know. Rates dropped for a bit too, so we'll see if that made any difference in anything.
Yeah. So, do you want to go into the deals now? Do you think anything else? Okay.
This is always like the best part. Is like the deal.
All right. So this is deal number 1. It's a long-term rental, a fourplex in Colorado Springs. I would say probably most of last year, I was like, fourplexes, I'm not, super thrilled about what I'm seeing. I know our client, Michael, he found a good few here and there, but I just wasn't seeing them in droves, whereas now I'm like, I think there's actually some really good opportunity for people, depending on the property itself. So this one is located on the east side of Colorado Springs. It was built in the 1980s, and it's had legacy tenants paying market rate rents, which I found to be an amazing but rare combination. Like I love when people have lived in, their homes for years and years and years. It means that they like the place, I presume. And then typically that comes with, below market rate rents, but this former landlord kept it up to market rate. So kind of the best of both worlds. You're getting your market rate rent, and presumably the tenants love their home. So like no action needed at that point. Found the property through off market. So shout out to Leah on that. She sent it over to me. Units are in good shape, and they need just cosmetic updates, I think, like, new carpet, new paint. We were able to negotiate a new roof and some seller concessions to pay for. There's some maintenance that I think needs to be done. Like when I was there for inspection, pretty much every tenant told me, I need this, I need that. Nothing major. But we definitely plan on going in next week, because we close on it today. We plan on going in next week and kind of fulfilling their maintenance wish list so that they're happy going into our, new ownership. Interest rate is not ideal, 7.5% for 30-year fixed, but the property itself works. kind of, I know I've alluded to it a few times, but trying to work on an evolved strategy for our rental properties. We're still kind of noodling through it, but this one aligns with what we're looking for. And it still has cash flow. So I thought that was kind of exciting. Yeah. So going into investor profile, it's for me and my husband. So we're not first time investors, and it's going to push us over that 20 unit mark. We're looking
Didn't I
to
recall you saying you wanted to slow down your acquisitions like a year ago?
Yeah. So kind of what I've been seeing is that all of our expenses have been going up, with the properties themselves, just in, personal life, like all the expenses are going up. So it kind of, it led me to do some thinking on it. And yeah, I think overall, I think we need to find something that has higher rental revenue potential, which this one does. So it also led us to identifying, for one of our single family homes that has pretty low return on equity, and we wanted to trade that one into something with higher rental revenue and higher ROE for the reasons that I just mentioned. So this one fit the bill. We're always evolving, and I think that just kind of looking at everything, and like, I don't think this is going to sustain us. In 20 years from now, I think we need some higher rental revenue opportunities as well.
Yeah. And I mean, on that individual single family home, the market gave you the gift of appreciation, and
Oh
you're
yeah.
cashing in that appreciation for, better leverage and a better income or better cash flowing asset. And
Hmm.
that's the game.
Exactly. Yeah, it was interesting. Like, that property doubled in value since the time we've owned it, but rents only went up, I guess, what, 20% or something. So,
Yep.
just to kind of show you that inverse effect on that. But yeah, so for this property in itself, the timing was not ideal for a 1031. So we're going to instead do a lazy 1031. But the reason why this property was so appealing was because this seller already has their up leg for 1031 identified, and they needed the cash from this property in order to complete that. So I honestly think that's why we got a really decent deal on this property. Ideally, like, the timing didn't work out. If I could, if I was queen of the universe, like, I would have waited a couple of months for this so that I could sell my other property and 1031 into it. But you can't have everything. And, I just wrote, you can't have your cake and eat it too on this. So you just
Yeah.
kind of have to be prepared for when opportunities come, and just kind of have those, different strategies to think about, like, okay, well, this isn't, a perfect 1031. So what else can I do? Okay, I'm going to do a lazy 1031. And it will pretty much, offset what I need it to, doing it that way. So we're actually going to use a HELOC on the property that we're selling. So that's kind of, comes full circle on that. So we're using a HELOC on the property that we're selling for the down payment funds. And then we're going to use the proceeds from the sale of that single family home to pay the HELOC down to zero, and then potentially recast or refinance using the remaining funds from that relinquished property that we're selling. So we'll kind of see, what we want to do when the time comes for that. Yeah. So that's kind of, the background of the decision making and all that for this particular property. So the type of property, it's a fourplex, 1980s build, two up, two down, 2-bed, 1-bath units all around. List price, well, I guess it wasn't listed, but price was $660. Purchase improvements needed. I was able to negotiate the seller to replace the roof and to provide some concessions. So I negotiated $2,500 in concessions, and then I think I'm probably going to have to come about $2,500 out of pocket to really get every single tenant's wish list accomplished, which is not a big deal. And why I like it, it's a 6.5 cap on a long-term rental in Colorado Springs, which is really rare. I think. I mean, we haven't seen this on just a long-term rental in quite some time. 1980s build, low maintenance, separate electric and gas meters, which I love because I hate shared meters. It's so annoying. I always come out of pocket having to pay for for water, trash, that sort of thing. So if I can get one more utility on its own meter, I'll take it. And then I think it's a better rental property than the property I'm selling. But I said that's for another presentation. We'll dive in deep to those numbers. But yeah, I think that the one I'm selling is a little bit less than a 4 cap, and this is a 6.5. So yeah, it's kind of interesting how that works out. And then just kind of some of the overarching numbers. I did not include the HELOC cost on this because I'm only anticipating having to have that outstanding for 2 or 3 months. But so once that HELOC is paid off, we're looking at a cash flow of just shy of $350 a month. And interestingly enough, if I use the residual cash from our proceeds of the relinquished property and recast this existing mortgage, the cash flow is pretty similar to what we're getting on that single family home.
Oh,
Yeah.
interesting.
I thought so too. So definitely something to consider when we get to that point. So yeah, that was pretty much deal one in a nutshell. And then we have deal number 2, which is a long-term rental. It's a fourplex in Colorado Springs. And this investor put 40% down. So in the previous example, it's only 25% down. This one is a lower leverage approach to it. Similar area, similar type of property, really. It was built in the 1980s. All units are 2 bed, 1 bath. But in this one, I would say the units are updated more nicely than the one that I'm purchasing. This one has new kitchens, new counters, bathrooms, and a washer and dryer in each unit, which is pretty rare for just your basic fourplex, at least in Colorado Springs that I've seen. Seller bumped up the rents to the market rate, and then they also put 100% utility bill back in place. So they commanded a higher purchase price, I think, because they put in that work to get the returns a little bit stronger. So the investor profile, he found this on the MLS. He owns multiple fourplexes. He's a house hacker and a fourplex investor. He has a full-time W-2. And the plan is to acquire his properties, which I believe he's done his acquisition phase. And he gets all of his buildings running smoothly to eventually evolve to eventually become an absentee owner or an absentee landlord. And he's very proficient. He's a very good self-manager. So, I think that this one might even give him a little bit of a reprieve since it's already fixed up and at market rent. I think this one's like one of the easier deals in his portfolio for him. And same thing, on the east side of Colorado Springs, it was listed at $750,000. It needed $8,000 in improvements because the seller left some, finishing touches incomplete, but they negotiated a $12,500 concession and purchased the property for list at $750,000. And the reason why I like this property is because it is a 6.5 cap rate on a long-term rental, is a 1980s build, low maintenance property, and 100% utility bill back in place. So the owner is only responsible for trash, which, as I just mentioned in deal number 1, I think it's easy, best when you have 100% utility bill back or separate meters. In all of my other fourplexes, I just have flat rate billing. And like I said, I always end up coming out of pocket for one reason or another. And then here's some of the numbers behind it. So since he did put 40% down, he's cash flowing about $930 a month after contingencies. So, his cash flow is higher, but it's also because he put a lot more down. But his cap rate is pretty strong, even though the property that, just kind of considering this, even though his property he purchased for $750 and I'm purchasing mine for $660, his rents are that much stronger and his lack of utility expenses is that much better to get him to that high of a cap rate. So just something to consider. And then, so for the last deal number 3 is...
Could you go back to that slide for a second, Jenny?
Yeah,
I think this
absolutely.
is a very interesting thing to note here. So for a lot of you that aren't looking at the screen, so Jenny's fourplex at 25% down was a 2.3% cash on cash return, about $350 a month in cash flow. This one's about $940 a month in cash flow at 40% down, but it's a 3.6% cash on cash return. So you're mentioning way more cash flow. since more money is down,
Mhm.
the cash on cash metric is not as big or not as high. Not right or wrong. It's just how do you want to manipulate the return numbers? Hey, put more money down for more cash flow. Great. Doesn't really a lot of times increase your cash on cash that significantly. So it's one of the
Yep.
fun things in real estate on and how you can manipulate your investments for the returns you want.
Exactly. Yeah, I think that's a really good highlight. So, deal number 3 is a fourplex in Pueblo, long-term rental as well. So, as you can see, the common theme between the 3 properties that I wanted to identify is that they're all fourplexes, and even with really high interest rates, they all work out. Which, like I mentioned before, I wasn't too jazzed about where fourplexes were performing in 2023. Just generally speaking, now I think there's a lot more opportunity out there. Like the sellers realize, like, hey, we either need to get rents up to where they need to be, or we need to drop prices, or a little bit of mixture of both. So it's very interesting to me. So yeah, I'm excited. So if you're sitting on the sideline for a fourplex, now might be the time to kind of evaluate some. So this one is the one that got away. It was a new build fourplex in Pueblo, townhome style units, 2 beds, 1.5 bath each. Something I really enjoyed about it was that they had mini splits in all of the units for heating and cooling, because it was all electric and all separately, separately metered, because they had separate electric meters, but then also separately adjustable, so each tenant could do what they needed at that point. The tenants were all paying market rent, and the landlord was responsible for water and trash. So investor profile, unfortunately, I don't know who bought it. It was not us. Originally, an Envision client did have it under contract, but they decided to go a different direction. I tried to get it next, but a cash buyer swooped in and got it. So it was a pretty good property, I thought. So again, we kind of went over some of those details. List price was $650. I put $0 purchase improvements needed. I can't imagine there is too much of material costs that were needed to get this thing after purchase. It was a 6.7% cap rate on a long-term rental. It was about $400 a month cash flow anticipated with 25% down. And it was a new build. So, presumably there is no CapEx in the near term. I said you should still save for it just because it will be coming. But, you won't have to expend it in the near term. So all that to say is, kind of highlighted some of that 6.7% cap rate. This is a 2.7% cash on cash return. So if you're only looking at that metric, not too exciting, but the cash flow just shy of $400 a month, and for a brand new fourplex. So yeah, Chris, which one of these deals would you pick if this were you, I guess?
I mean the high level, I would say yours and Springs, more so with the two themes being I like the higher leverage play, and I really like the Springs market. I think it's just a very robust economy and robust market. So higher leverage, and for a pretty similar return profile, I would rather go on Springs, which is just a more robust market than Pueblo. So
Yeah.
if you want to add me on the deed at closing day, Jenny, since I won that round, I will send you my details.
All right. Sounds good.
Right. All right. Glad to be having a verbal agreement that you listen to that now. No, that's why I like yours. I just out of those three, I mean, I keep, I'm a much more like 30,000 foot view type person for, hey, what are the main themes and strategies, and just leverage, and hey, the better market you can invest in, I'll always go for that. Like if I'm going to invest in another market, I want a better return.
Yeah. Yeah. That's what was interesting when we lost out on the Pueblo deal. I was pretty bummed out for it. And then, this other, deal number 1, came along, and I thought about it, and I'm like, well, even though it is, quite a bit older than, a brand new fourplex, just, I think my, overall risk profile, like, we always like to tell our clients, think of it as a sliding scale. Like in Pueblo, you're probably going to have a little bit more vacancy than you are in Colorado Springs. You just kind of have to think about the different components that can't always show themselves in an analysis, I suppose.
Yeah.
Yeah. So, yeah, that's kind of what we're seeing right now.
I'm curious
Yeah.
for yours, Jenny. Did it
Mm-hmm.
factor in just for? I mean, you self manage. You
Mm-hmm.
have you're closer, and you have a more established presence in Springs than Pueblo. Did that factor into your decision making as well? Does that like go on your sliding scale?
It did. So, but actually, for the opposite of what you described. So, yes, numerically, like I do have an advantage. Like I have a whole, good contractor network. I'm very dialed in on the market itself. But I was kind of thinking, oh, I have a really good property manager in Pueblo. It's a little bit of a crutch that I can rely on them to manage it and take some off of my plate. And instead, I just added more to it, but it's okay.
The way it goes.
Yeah.
And one thing I want to loop back towards, you talked about, hey, you missed out here on the new build number 3 fourplex. It's always a bummer when you miss a deal, like, I just didn't work out. You know, investing in deals, they're like the bus. There'll be
Mm-hmm.
another one, not maybe 15 minutes later on the next route, but there'll be another one in their future. Like,
Oh, yeah.
no one deal ever make you. One deal could absolutely break you, buying
Mm-hmm.
a horrible deal. But like, hey, he missed a deal. I get it. I've been there. It just happened to Jenny as well. But if you're patient and you keep looking, usually something just as good or sometimes even better comes along the way.
Yep.
So
Yeah. I think about that all the time. Just, even 8 years ago, some of the stuff I passed up on, like kicking myself now. I'm like, oh, that was such a good deal. And I didn't realize it when it was right in front of me. But then I'm like, well, I was able to buy, this property
yeah.
instead. And those are also great deals. So, yeah, I completely agree. I like your bus analogy. Mine, I always tell people there's plenty of property fish in the sea, but I like the bus one better, I think. So I'll start using that one.
All right. Well, Jenny, this was awesome. Thank you so much for getting the data here together. And if anyone out there is curious about, some of the specific moves Jenny made with her trade up, or her lazy 1031, I should say, let us know. If you're interested in exploring investing in Pueblo or Springs, whether it's a house hack, room by room, or fourplex, reach out to us. Jenny and Leah, they're plugged in. They consistently find deals. They know the market. So if you're interested in this market, let us know. Would love to sit down with you and help you figure out your options and start getting some deals into your inbox. So Jenny, thank you so much. And we got to get back into rhythm, doing these a little more regularly. So we'll be doing another one here. Maybe next quarter is
Yeah.
it's kind of like the wish list right now. So stay tuned, and listeners out there, let us know what aspects you like and what information you want to hear more of when it comes to Pueblo and investing in Colorado Springs. So
Thanks,
Jenny,
Chris.
thanks so much, and good luck at your closing today.
All right. Thank you.
Bye everyone.